G'day guys, Ian Jordan here from the Selector Group. I wanted to give you a quick update on inner Sydney units. There's a few things that have been happening over the last 5 to 10 years, and things are starting to culminate in what I think is possibly the bottom and potentially the best time to buy. So let's start off. There's no secret that everyone's cautious, but the recent 2011 census data that we've been looking over has indicated some very, very interesting changes. For example, 40% of people in Sydney actually live in a unit. So people around Australia watching this probably will be considering, why would you buy an investment unit? Understanding that actually 40% of Sydney's population living in a unit kind of indicates that it's quite an acceptable part of living in Australia's society now. Population in New South Wales generally was 1.1%. In Greater Sydney was 1.3%, but in inner Sydney was 1.7%. So that's actually a reasonable growth curve, considering the general demographics of Australia. The other interesting thing that I find with the census data is that 53% of people in this particular inner ring are renting. Now, the general population of Sydney in the greater area is 30% of people are renting. So this particular area has a higher proportion of renters than other people in Greater Sydney. Vacancy rate in this particular area is still very low. It's sitting at 1.6%. So that's an interesting thing for people if you're considering the possibility of buying an investment property in this area. If we look at capital cities and we take a timeline from 2000 and over the last 10 years. So if we look at, say, 2002, 2003, I consider that 2003 was in fact it was probably the peak of Sydney's property boom. And at that particular point, if you look at the capital cities average, Sydney actually had a 55% higher premium. So compared to other capital cities, you would pay a 55% premium just to buy in Sydney. Clearly, I think that's probably overcooked. The market's agreed, and now if we have a look 10 years later, there or thereabouts, we're looking at a premium of only 23%. Now, what's happened over that period of time? It's not so much that Sydney's retraced or gone back in price point, but what's happened is that the other capital cities have actually caught back. And what's that meant over the last 3 or 4 years is that generally property's been struggling, and everybody's aware of that. Buyers are cautious, so everything's sort of slowed down. What we've noticed here in Sydney is that the softening hasn't been as marked as other capital cities. That gives us an indicator that this is probably around a fair price point as to where we are in relation to other capital cities at the moment. If we have a look at, in fact, we've got a client who's looking to purchase a property. It's a 2-bedroom, double-storey unit in Glebe, and the interesting thing with that is that we did an RP data property search for them, free of charge, of course, and we found that the property was last purchased in this peak time, and they're looking to pay exactly the same price. It was $825,000 in 2003, and our buyer's looking to purchase it at exactly the same price. So that gives you an idea that the Sydney market right now is probably equivalent from a dollar perspective, very, very similar to 2003. People talk about new stock coming onto the market, and that's always a discussion. A lot of people push this barrow. Give you an idea, in 2011, 2012, that in both years there were about 2,300 new dwellings came to market in that period. Quite interestingly, in 2013, there's forecast to be about 4,000 new dwellings coming to market. Now, to give you a bit of comfort around that, because that is a bit of a spike, 4 of those dwellings across Broadway and Zetland actually account for 1,600 of those new dwellings, so they're in massive development sites. We're seeing that when these properties come to market and they're finalised, the pre-sales vary between about 40% and 60% actually already pre-sold. So that gives you an idea that things are still fairly strong, and they're being reasonably well supported even in the current market. Rentals. If you're looking for an investment property, this is obviously a very, very big component of what you need to look for. The Sydney in the market in this particular area has in fact been growing at around 5.5%. That's at June 2012. That's an annual growth figure for rental. So that means that if your rent was $100 in June 2011. In June 2012, you would expect it to be about $105.50. So you get an extra $5.50 on your rent. So that's actually pushing rents up. Have a look at the 10-year average. Again, I'll just use this curve. Effectively, this is the average curve, and the average price on a rental property, or what you would be getting as a yield, so what rental return would you be getting on that particular property, would be at about 4.25%. In inner Sydney, it's actually running at 5%, which is a little bit of a premium on what average rentals are. Now, for a long period, for probably about 10 years, putting your money in the bank has actually been generated a better return from the point of view of cash coming out. So if you're looking at a yield basis, putting your money in the bank over a 10-year period has probably given you a 0.85, call it 1%, better return. So most of the time what you would be seeing over the last 10 years that you would have been receiving rentals and money back from the bank of around 4.25%, there or thereabouts. It's been up, it's been down, but both of them have been following each other. Now what's happened is that the rental curves have actually come up and the bank curves have actually come down, and we're now seeing for the first time in more than a decade that it's you'll get more money from your rent than you will if you had your money in the bank. So that's an important sort of point, because it helps other investors make a better use of their money, and that might in fact be in property in this particular instance. There was a short period in 2009 where there was an emergency situation, and rents did in fact increase dramatically. So taking that out, that's the general story over the last 10 years. What's another massive influence on what's happening at the moment? This affects general affordability around the country, and that's interest rates. So interest rates have in fact been dropping, and if anybody's been following this avidly, they'll know that it's been dropping, but a lot of people haven't been following it. So I'm hoping that you'll see this and understand the ramifications for these lower rates. We're currently sitting at around 0.5% below our 10-year long-term average, so 0.5%. Now 0.5% doesn't sound an awful lot. Now futures markets actually indicate that we're probably expecting around another 1% cut in official interest rates. Not all of that will be passed on. My suspicion is that the banks will keep their claws on a lot of it. However, that extra 1%, if it's passed on, will dramatically change the landscape of affordability, both for owner-occupiers and investors. So, you know, just keep watching that, because that's going to really impact the affordability equation. I'll go into some examples. Who's buying? The government wants support in the new property market, and they realise that there's a shortage of stock, so therefore they're incentivising certain people to buy properties. Up until June 30, there was an incentive for anybody buying a new property. Now they've targeted that, and as at 1st of October, they're going to be releasing the new incentive for first home buyers. This is a massive incentive if you're going to be buying a new property. Now, a new property, if you're a first home buyer, you will get a cash bonus of $15,000, and you will also receive, in addition to the $15,000, you will receive no stamp duty for purchases up to $550,000, and then a degradation of that down to $650,000, where the benefit's gone entirely and you'll have to pay full stamp duty. So that's a really interesting point. So up to $550,000, no stamp duty. Let's talk about affordability for a first home buyer. If you're buying a $500,000 property and you've got a 20% deposit, so let's say that you've got some money to put in and you're going to borrow 80%. Okay, so that means that what you're going to be borrowing is you're going to be borrowing $400,000 from the bank. Borrowed. Now, at the moment, I know that we can get fixed rates at around 5.6. I know I saw a flyer come through the other day with fixed rates cheaper than that, but I'm going to use 5.6 as this example because I know we can get that, and I think that you know, they're all around that sort of number. So we'll use 5.6 as the example because that just shows you. So at 5.6%, the actual repayments on that on a monthly basis come to $2,300. So $2,300 are the repayments. Now, to rent the same property, so dollar for dollar comparison, to rent the same property, it will cost you about $2,000 a night. So this is to own and $2,090 for rent. These are on a monthly basis, and this is to rent. Oh, I said that twice. So the interesting thing here is, so what does that work out to be on a weekly basis? On a weekly basis, you'd be looking at around $50 a week. So the cost would be $50 a week. So if anybody's using that old, famous old phrase from mum and dad, which is rent money's dead money, and you can come up with an extra $50 a week, this sort of scenario starts to make a lot of sense. We're nearing that point where it's actually looking like it's almost as cheap to buy as it is to own, and you're going to get the same sort of quality of life. So the other bonus with first home buyers is that you don't pay stamp duty. That's a saving of anywhere between $15,000 and $20,000, and you also get $15,000 cash. So in this particular instance, in this scenario, what would happen is that you would only need $85,000 of your own money, because the bank's going to give you another $15,000 as the deposit, and you actually don't need any costs. So that's that's a pretty reasonable sort of incentive to get into the market. Now clearly you can borrow more than 80%. Using this just as an example, so if you don't have $85,000 but you've got a sum of money collected, you still might be able to take advantage of this. Clearly what would happen is that your repayments would probably be higher. But give us a call if you're interested or you'd like to discuss that. Okay, so let me rub the whiteboard out again, and we'll talk about investors. With the example, we're using the same stuff. So we're talking about $500,000 and a $400,000 borrowing. Now the borrowing at 5.6% again, so 5.6%, well, this time what we're going to be doing is we're going to be borrowing the money interest only because it's deductible debt, and we're assuming that you have other money that you have to pay off. In this particular instance, your repayments are going to be $430 a week. Now your rent, because we're getting at about 5%, actually comes in, your rental actually comes in at $480 per week. And it doesn't take Einstein to work out that you're pretty positive in this particular situation. Clearly you've got to look at it, you have to look at your own tax rates, you have to look at the cost of running the building, you have to look at the depreciation, that sort of thing. So this just shows you how affordable it is to actually buy an investment property in the current market where rents are so high and the affordability is so strong. Interesting comment on investors are SMSFs. So SMSFs, as you're probably already aware, can borrow money to buy residential real estate now. And this is meaning that people who probably don't want their super money in the volatile share market, even though you're getting pretty reasonable returns, you're getting around 5.12 as at June. On the ASX 200 you're getting that sort of return. This yield is still very, very strong. So just be aware that SMSFs are also starting to come into the market and looking at purchasing properties because of the affordability situation and the potential for capital growth. Look, that's probably it. Let's go through a quick summary. The things that I'm seeing in the market generally are that interest rates are falling. Okay, so interest rate falling means generally that affordability is pretty reasonable. Have fallen over the last 10 years. And that's also contributed to strong affordability. So lower prices and lower interest rates. The next impact on that, especially if you're an investor, is that rentals have actually increased. So rentals have started to increase, which means that that helps you in servicing your debt and maintaining that property. The next thing that rentals are doing is obviously making it less affordable for first home buyers and owner occupiers to and renters to actually stay there. So I don't imagine this is going to stay for a long period of time. However, it's certainly here for the short to medium term. And I think is adequate, and that's shown in June where we had a moderate price increase for the year on date. So I think that that's a reasonable sign. And auction clearance days are also starting to improve quite dramatically. So I think that we're starting to see some signs of certainly stability, if not the market starting to turn around. We're in that sort of bottoming period, I feel. Nice time to look at. I think you've got some time to look. There's no rush, certainly from my perspective. But if you're interested in that inner city market and you would like to learn more, don't hesitate to give us a call. Alternatively, get into all the normal property sources and see whether you can find yourself a bargain. Until next time, give us a call.